Okay, and welcome back, students who are taking Math for Business and Finance and Math applications. And we are continuing on with the theory for Chapter 18, Inventory and Overhead. And in this second video, we are going to be talking about the specific identification method. So this is a valuation method in order to determine our cost of goods sold. Okay, and this one really is very, very simple. With the specific identification method, it works best for big items that you don't have a lot of, okay? And just as the name implies, it's a specific identification, okay? So, the formula for it is the cost of goods available for sale minus the cost of ending inventory equals the cost of goods sold. So if you were watching the previous video, you had seen me write that on the balance sheet, you have your inventory account, and at the beginning of an accounting period, you had your beginning inventory and whatever amount that happened to be, okay? And then, of course, you added your purchases. However many times you purchase, they would get added, okay? And that would give you a cost of goods available for sale, right? That would give you that dollar amount, your cost of goods available for sale. And then you would take a physical inventory and whatever amount that was, you would subtract it from your cost of goods available for sale. And the difference is your cost of goods sold. Okay. And of course, that cost of goods sold, you would make some kind of entry in order to put it on your income statement. So yeah, that's the specific identification method. In theory, and no, that's the way your cost of goods available for sale and your cost of ending inventory works in order to get your cost of goods sold. However, that in that theory, we're talking about buying a lot of stuff and not paying attention to so much what's been sold and making the transfers from inventory over to your cost of goods sold over on the income statement. With the specific inventory method, it works for things such as automobiles, and that's my best example of it. On the car lot, when you have a car dealership, you might have what, I don't know, 500 cars, say, okay, and whatever the total value of that 500 cars, right? Those 500 cars is what your inventory amount is, okay? Now, when someone comes to the car dealership, they want that specific car, that make, that model, that color, whatever it is. And that item is the one that they're purchasing. So out of these 500 cars, maybe they're looking at, the car on the lot 396, okay? And let's say that costs $40,000, a cost for the business. Now, they're selling it to the customer, say, for $50,000. Okay, so that's the revenue, right? The sale. And because we know exactly which one they want. And let's just say my total inventory happens to be $1 million. Okay. Because they know exactly which one they want, and because it's easily identifiable, when we make the sale, we record the sale, and then we also make the entry to take that automobile 396 out of the inventory and move the $40,000 over to our cost of goods sold. Okay, when we do that, you know, on our income statement, if we ran one, that means our gross profit would be 10,000. But we're not going to do that every time that we sell an automobile. You know, we're going to do that at the end of the accounting period, you know, because we would have our total revenue plus our total cost of goods sold. But by taking it out of the inventory, now instead of having a 1 million in inventory, we're taking the $40,000 out, so that means we would have $960,000 left in inventory. Okay, so when we got to the end of the accounting period, that would be our ending inventory would be the 960,000. Now let's just backtrack a little bit, and I'm going to erase a little of this and put it back in, hopefully. Okay, we have 500 cars in the inventory, and that's worth $1 million. Okay, those 500 are worth $1 million. Now, you know, let's say I have a truckload of cars that come in, and let's say there's 10 cars on that truck, and that's worth an additional $400,000. Okay, well, those 10 cars are my purchase, right? And so now my total goods available for sale are $1.4 million. Okay, and I can have you know, and maybe I'm going to have some kind of show where I expect to sell a lot of cars, so I end up purchasing another 10 cars for another 400,000. Okay, so now my cost of goods available for sale is $1.8 million. Right, and now let's say, you know, so that's my cost of goods available for sale at any moment in time. Okay, so now when, you know, while I'm waiting for that show to come along, somebody comes and they buy car number 396. Okay, and so I have to move the $40,000 out of the inventory because we're using specific identification, and so now my ending inventory is $1.76 million. Okay, so that's my ending inventory. Now notice that it is not my goods available for sale. My goods available for sale was the 1.8 million because it's everything, it's my beginning inventory plus all of my purchases before I take out anything that I sold. You know, it's goods that were available. So the most I had available was $1.8 million for sale. Okay, and then I take out the specific ID of 396, which gave me 1.76. Now, to take it, you know, if I want to take it a step further, real quick, I'm still sitting at 1.76 million, right? And let's say, you know, the show still hasn't happened, and somebody comes and purchases car number 127. Okay, again, specific ID. I know exactly which one that is, and let's say that was for $60,000. Okay, so my inventory is now 1.7 million. That's my ending inventory at this point in time. My goods available for sale is still my 1.8 million, but because I took this 60,000, now let's say I sold that car for 70,000, so I would have recorded the sale, and that means I would have added 70,000 to the 50,000, so that gives me 120,000. And of course, the 60,000 for the cost of the car, I'd move it, you know, to my cost of goods sold. So now instead of 40,000, it's 100,000. And of course, that means that instead of having 10,000 in profit, I have gross profit. I have $20,000 in gross profit. Okay, so that's kind of how specific identification works. You know, what you have in your inventory, you know, you're able to specifically identify it because you don't have that many of them, and it's very easy. You're able to track those items. The same thing can happen with furniture. I mean, you have a warehouse. Yeah, you have a bunch of tables, chairs, dressers, beds, whatever have you, but you're able to specifically identify each and every one. Specific identification, I mean, you can take it, a step further to sit there and say, okay, what about my grocery store? Okay, I mean, think about a grocery store. I mean, on the shelf, you have these cans of beans and cans of, jars of spaghetti, loaves of bread, milk, and each one you can specifically identify each one. Yeah, and at the end of the day, how are you going to back out each and every item that's purchased? Because, how many customers do you have going through the store a day? 100, say, and they're buying all kinds of stuff. I mean, now it all of a sudden becomes insane for you to be trying to specifically identify each and every item and take it out of inventory, right? Can it be done? Yes. I mean, when you go into a Walmart and you're scanning the stuff across the scanner at the cashier, it's all tied in to be able to say, okay, I had 20 pair of this kind of say jeans, right? And when somebody buys one, when you scan it, now all of a sudden it's taking that one out of there, and so now you have 19 left. However, that does not account for things like theft and breakage. I mean, in a grocery store, somebody drops that bottle of spaghetti sauce, okay? You have to account for it, but you don't know it. You're not going to take that out, to take it out at that moment in time, because a sale wasn't made, okay? Of course, you'd still end up having to do an ending inventory, right? Which now brings me to this idea of ending inventory, right? So if I'm looking at these cars and I'm saying, okay, I have 520, this 500 plus this 10 plus this 10, so I have 520 cars, okay? And when I go to do inventory, well, I don't have 520 left. I sold these two, so that means I only have 518, okay? Well, whatever I'm showing, all right, should, as part of my inventory system, should be what I have on my books, the 1.7 million at the end. Because I'm using cars, I mean, unless I know that, a car was stolen off the car lot, which let's say it doesn't happen, I don't really have to make an adjustment. But if I was working in a grocery store, like I said, you have theft and breakage, and now all of a sudden, even though you were using specific ID for the grocery store, you're not able to account for those things readily. And so at the end of the accounting period, what you think you have on the shelves is not what you have. What? And so that's not what's on your books. Okay? So you have to make an adjustment for those items. So the specific identification method does not become practical for when you have a lot of items. Okay? Sure, I can use specific identification for 1,000 automobiles because I can identify each individual automobile, but to be trying to pay attention to cans of soup and stuff like that in a grocery store, that method doesn't work that well, and so that means we have to use a different method for inventory valuation, okay, which is what we're going to cover in another video. So with that said, hopefully you understood this, and if not, go ahead and rewind and watch the video again. It's not that difficult, all right? It's just basically, here's what I'm keeping a log of what I have in inventory, okay? And when I sell something, I take it out, because I know exactly which one it is, and I put it over to cost of goods sold. So I'm reducing my inventory when I take it out at that point in time, right? So with that said, I will see you in the next video for the next method.